businesses. There's some very high ROE businesses, there's some very low ROE businesses, and I'll give you examples later on. But ROE is the most important thing because tomorrow, let's say you have this business where you've put in your money and you're earning a rate of return, and I come to you and say, I want to buy your business. You have to know what the price of your business is. You won't sell it to me at 10 lakhs, right? You'll sell it to me at a premium because of this ROE. So I'll explain that. The term for a company is infinity. We assume that companies will last forever. They won't shut down after 10 years like bonds. So there's a longer term of interest, a rate of period. And finally, interest rates in the system are the same, which is whether you're looking at equities or you're looking at bonds, the interest rate in the system is your basic hurdle rate, 8%. So when we look at a company, we're always looking, just like in a bond, we said this extra 2%, you will factor into the price or the premium over here. The same way in a company, this gap is the additional value that the company is generating for you as a shareholder. Your choice was to earn 8% risk-free, but with that company you're earning 20%. So this gap is the premium, the extra return, and therefore, when you look at the share price of that company, it will be a multiple of book value based on this gap. So let me give you an example. When we look at Hindustan Unilever, for instance, why does that share trade at such a high price to book multiple? It trades at 30 times price to book. And the reason for that is their return on equity is close to 80%. You have an 80% return on equity, 8% rate of interest. So he's generating that much extra value for you over a number of years. Therefore, today, you have to pay a massive premium to book value if you have to buy Hindustan Unilever. So the concept is basically linked to the two. So the bigger the spread, the higher will be the price to book of that company. Now, I hope this sort of concept is simple because now I'll just move into examples here. So whenever we look at companies, there are broadly 3 types of companies. You can segregate the whole market, any listed company, into 3 categories in your mind. The first category are what we call defensive companies. Why are they called defensive? They're called defensive because these are businesses where this ROE, return on equity, doesn't fluctuate too much every year. The profits don't swing up and down. They tend to grow very consistently, and therefore the ROE also moves in a certain band. So what are defensive sectors? Pharmaceuticals. They don't go through economic cycles. They don't require much capital. If you were a person setting up a pharma company, it doesn't take much capital to set it up, but it's more a technical expertise you need to have. But they earn a very good return on capital because the capital investment is very low. So pharma companies earn 25% ROEs, most of them. And in a good year, it'll be 30%. In a bad year, maybe it'll be 20%. But that's the range. Another example of a defensive sector is consumer companies. Colgate, Levers, Britannia. They all have very consistent ROEs because, again, they don't have to set up big plants. It's more a brand business. And once you establish the brand, you end up making a lot of extra profit margin. And the growth is fairly steady. So they also tend to trade at very high price to book multiples because of very high ROEs. But these are very steady businesses. So when we look at investors, if you are the sort of investor who can't tolerate volatility, who likes safe defensive sectors where the price moves up regularly over a period of time, defensives are an easy way to invest typically. So defensives give your portfolio a very steady quality. It's not that defensives don't become expensive. In fact, at this point, you could argue defensives are quite expensive. But over long periods of time, what we've seen is they do end up performing. So if I look at over the last 20 years, the companies that have generated the maximum shareholder returns for investors, in the top 10 companies, you will have 5 or 7 of them actually will be all defensive names. So defensives are companies like this. Automobile companies also have been defensive because they've been growing very steadily. Pharma, consumer, to some extent IT companies. The second category of companies, which is what causes more of the heartburn, are called cyclicals. Now cyclicals means any company which is linked to the economy. So these are companies that make very heavy investments into plant and machinery. I'll give you an let's say Hindalco. Now Hindalco, what do? They make aluminium, and aluminium is very power intensive. So when you set up an aluminium plant, you have to anyway invest heavily into aluminium, but you also have to invest a lot into power. So what happens is, the first time you have to put in a lot of capital investment. Now when the economy is doing well, your plant is running at full capacity because there's lots of demand. So you make a lot of profits. You can charge whatever you want. Your costs are mainly fixed costs. Once you've put up your plant, that's your biggest fixed cost. So a lot of that, in a good economy, you make decent ROE. So Hindalco will make a 25% return on equity in a good, in a good economy. But what happens is when things go bad, when your economy slows down, the costs are still the same, your sales start dropping, demand suddenly disappears, and therefore your profits fall much more dramatically than in defensive companies. So what happens then is, in a bad year, Hindalco's return on equity will fall to, let's say, 5%, or it may even make losses. So this is, I'm just giving an example, but it applies to any business that is capital intensive. So power, steel, industrials, etc. Now, what does the market tend to do? Now, this is where it becomes interesting, because why are prices so volatile? Why do they move up and down so much? The reason is, and this is the mistake the market makes in some ways, what the market does is it looks at the ROE of the company in this year and assumes that is the ROE for the life of that company, and then puts a price. So for example, give you Hindalco's case, let's say it's a bad year, their ROE is 5%. What does the market think? The market says ROE 5%, interest rates 8%, which means you are earning less than interest rates. There's negative value. So the stock should trade below book value. Why should I pay even 1 rupee premium? And these stocks fall below book value at bad times. So today, Hindalco is, let's say, at 0.6 times book value. But the fact is that you can't have 5% ROE lasting forever, because if it was the case, Hindalco would have shut its business a long time ago and said, what is the point of running a business? I might as well sell everything and put it in the bank and earn 8%. You don't do it for charity. So why cyclicals stay in business is that when things are bad, they earn 5-7% for maybe 3-4 years. But when things get better, they earn 25%. So they make up for, on average, through a cycle of a down and an up, they'll maybe make 15% on average, and that keeps them going for years because they're fine. They're earning more than interest rates in the system. So the psychology really in cyclical investing is that you have to be very contrarian. In defensive investing, you can just buy and keep it forever and not really bother too much. In cyclical investing, you can end up making a lot of money, but you have to be contrarian in your mindset, which means that when ROEs are down, when the economy is slow, things are looking bad, even when we go and meet those companies at those times, they themselves are depressed. They don't feel there's any hope on the horizon. But that's when these stock prices also tend to bottom out. So when these stocks reach half book value, for instance, typically around half to 1/3 book value is where these stocks bottom out. That's where everybody knows things are horrible. Whoever's had to sell has sold. And from there, whenever the next cycle comes, and let's say the ROE gets back to 20%, at that point, the market starts thinking 20% will last forever. And then the stock goes to 3 times book. So you go all the way from half of book value to 3 times book value, which is a 6-time return you can see in these names. And at that point, of course, everything looks fantastic and it looks like a 20% ROE will go on forever and India is the greatest country and will keep growing. But the fact is, these are cyclical. So then a cycle comes again and then things slow down and the ROE goes down and the same old cycle again. So the thing in contrarian investing though is it's not easy, because you open the papers, you see depressing news, these stock prices are falling every second day, you feel, what is the point of owning these shares, they're useless, etc., etc. And, finally you get tired and you say, forget it. And typically, after that the economy suddenly picks up and whatever. So the fact is, contrarian investing is very, very difficult, whether it's for you or for even us as fund managers. It's very difficult to take that psychology out of your system and to time it perfectly. But if you do, there's a lot of return that can be made as well, because whenever a cycle comes back, there is a big swing in returns that you will not make from a defensive in that period of time. So that is the difference, and it requires a totally different investor mentality. The third category of stocks are what we call growth. So there is defensive, cyclical, and growth. Growth means, and these have come few and far between, it's not very easy to find them, but growth, the best example of that is the IT sector in 99-2000, where they were growing really fast, they were growing every year by 30-40%. They were also earning very high ROE, they were earning 30-40% ROE. Now when you take a 30-40% ROE and on top of that you're growing it at 30-40% every year, there the stock prices can just go ballistic. People will be happy to pay 50 multiples, 60 multiples, 70, it will become a bubble eventually, until growth slows down and normalizes. But if you ever find a company that is very high ROE and very high growth, chances are, it tends to become something really big and a lot of people start chasing it. So these are the three sort of categories of stocks, and they almost require three different compartments in your mind to invest into them. You can't treat everything with the same lens. Today when we look at the Sensex also at 28,000 index, there's a lot of difference between defensives, cyclicals. If you were sitting with Hindalco at this index, you'd be quite depressed, frankly. You would say, what bull market are we talking about? I have not made anything. But on the other hand, if you were sitting with a Britannia, you'd be ecstatic because it's ended up doing incredibly well. But these two can be herd mentalities. So you can end up overstretching into defensives at certain points in time. The only good thing about defensives is when they become very expensive, they go through time correction. It's not like you lose a lot of your capital. You may lose a little bit, but over time, it comes back. You may not, Hindustan Unilever, for instance, very few people remember. In 1997, it was one of the darlings of the market. Hindustan Unilever used to be 10% of the Sensex. And then for 10 years, the stock didn't perform. From 1997 to 2007, the stock price was the same. And now in the last 8 years, it's come back all the way, and it's done better for that entire time frame. So even defenses go through these phases, but the good thing about levers was you never lost a huge amount of money. Unlike a cyclical, where if you buy it when it is at 3 times price to book, and then it goes all the way down to half price to book, that is horrible. You see 80% loss and you get fed up and you sell it. So it's really, there's a bit of personal aptitude involved here in terms of how you select your sectors, stocks. And as fund managers, so the easy way, of course, which we always, when we put on our marketing hat, we say, listen, we'll take care of all that trouble for you, just give us the money. But the fact is, what we also have to do is compartmentalize our portfolios into these categories and say, how much will I keep in defensives? Even if they're expensive, how much do I bring them down to? How much should I keep in cyclicals? What growth companies can I find? And then keep a mix so that you end up performing well over a period of time. So that is really the whole sort of style and psychology of investing. But what you have to remember is, in investing, invariably time is your friend, or the longer time you spend on a good company with a decent ROE, the better off you will be. And impatience is the worst enemy of investing. Trying to time the market, timing is a bad thing. Impatience is a bad thing. Listening to the noise around you is a bad thing. The simple thing is actually to do very little in equity investing. Just do good work at the time of making your investment. So if you're buying a mutual fund, just look at the past track record, you can find out how long the people have been working there or whatever, or it's a good house or not. Once you've done that, you just have to stay with it. There's not that much to differentiate people. I think broadly everyone's of a similar intelligence. But very few people just stay with things. They tend to always look at chase, which is the fund that has performed best the last year, last 2 years. But everyone will go through a cycle. Over 15, 20 years, everybody will be more or less the same. So the key is to stay with it rather than keep switching, keep moving. That's what creates the errors when you keep looking into the rear view. I'll again give you a couple of examples here. I remember we had set in 2005 November, we had launched something called a super SIP fund. It was a very interesting concept in those days. So the concept was you put a monthly SIP into our funds, and we said, since there'll be so many investors, we can take all those investors together. We went to Bajaj Allianz and we said, listen, we can get you 100,000 investors, so you give us term insurance linked to it. Term insurance is the cheapest form of insurance. And since it is a group, you can get group term insurance, which is cheaper than what you can get as an individual. So the absolute cheapest form of insurance along with systematic investing. So the best of both worlds. You do investing into good equity funds and you get insurance at the cheapest price linked to the amount you are investing. So that was supposed to be a blockbuster product. It didn't end up being a blockbuster product because what we didn't realize was that the big banking channel distributors, they would earn a lot more just by selling insurance separately because they were earning very high commissions and funds separately. So they didn't want to hurt their own commissions. So they didn't sell it at all. But the reason why I'm talking about this is, I remember we had 21-year SIP plans in that, 16-year and 21-year. And we had also invested personally into it. So I remember this was a year and a half ago in September 13, when things were really bad. If you remember, the rupee had gone to 67, 68. There was a lot of panic in the world at that point. The index had fallen. September 2013. That's when Raghuram Rajan became the governor just after that. And I went to Chennai and I was talking to investor gathering, and one person said, listen, you talk of long-term investing. Now your super SIP, you invested 2005, it's now 2013. And the compounded annualized return on this instrument is, at that time it was 7 or 8%. So I said, what is this sort of long-term investing? What is it bringing in equities? And the point we just made was, listen, all you need in SIP or systematic investing when you're putting in money every month is you need one bull market and everything gets mark to market, right? So if we fast forward to today, those same SIPs today are 16% annualized for the entire time frame with just one quick move in the market. And then suddenly it all makes sense. And then you suddenly realize equities is pretty good if you just hold on. The other thing why equities has to outperform debt over long periods of time if you're a long-term investor is the very simple concept of this. At the end of the day, if a company was not earning returns higher than what you could get in debt or in bonds, no company would be in business. The very fact that companies exist tells you that equities has to outperform bonds, right? Because for a long time, if they didn't deliver the ROE, they would shut shop and put money in bonds themselves. Why would they be in business? So equities has to outperform bonds over long periods. The question is how many people can last those periods and sit through it. So SIP investing is something personally I feel very, very strongly about. I think it should be made mandatory, frankly, if we had a choice. Just like you put money in the bank and you don't question it every month. Let's say somebody's salary goes into the bank, or if you run a business, periodically you put money in the bank. Why not the same with equities? At the end of the day, it's going to generate a higher return eventually over a period of time. And it's tax-free. It's more tax efficient as well. It definitely is the best wealth creator you can get across most asset classes. I keep getting the question on real estate every now and then because real estate probably has created, it sounds like it's created a lot more value. But if you actually do the numbers over 20-year periods, you'll notice when we talk of real estate, we remember that I had bought this house at 50 lakhs and now it's worth 2 crores or something like that. But you don't understand how much in 20 years, 50 lakhs going to 2 crores is what return. Whereas we've actually compared all these numbers and we can send it across. Equities and real estate have done similar returns. And the beauty about equities is it's more liquid. If you ever had an emergency, it's easier. whereas real estate, as we all know, is not. So anyway, just coming back to the point, I think equities, I mean, I'm a very firm believer, and obviously I'm a biased party here, but the fact is equities, without doubt, is the best long-term wealth generator that you could find. I think India as a country is very blessed with some fantastic entrepreneurs and businesses. It still amazes me every day when we go out and meet companies, how many fantastic companies there are doing such fantastic work, generating good ROEs that you can participate in. And that's one of the biggest perk of our job, frankly, is that we get to go out and meet some fantastic individuals who set up great companies. You get to meet with them, you get to talk to them, you get to question them. They tell you about their business, they explain the ROE, they explain where they're going to grow, and you get paid for all of that. So it's an awesome job. But at the end of the day, what's important is sticking with it. The lessons we've also learned as fund managers, and we've made countless mistakes ourselves. Very often, when you get caught up with the noise, that's when you make mistakes. When you get caught up with emotion, that's when you make mistakes. Because that really just takes you off the very basic philosophy of why companies are there and how much money you can make over time. So do your work at the start, whether you're buying a fund or you're buying a share, and then hold on to it, is the only advice I can really give. And use time as your friend rather than impatience as your enemy. So with that, I think I've said enough. I'll just pause here. And if you have any questions, I'd be happy to take them.
Today we are celebrating World Investors Day. So it's actually today your day. And today is the best forum to ask questions to him, because he's the one who is managing money. So he's managing 25,000 crores of yours money, 25,000 crores. And one of the flagship funds which he manages is DSP Blackrock Equity Fund, which has been in existence for the last 17 years. And I'm proud to tell you this about this industry. For the last 17 years, the fund has given an average return of 25% compounded per annum for the last 17 years. This is a mind-blowing number, by any stretch of imagination. So this is the power long-term investing can do to us. But as he rightly said, how many of us have enjoyed these kind of returns? So please feel free to ask questions. You can ask questions in Hindi, English, whatever language you feel.
Speaking about long-term investments, okay, but at what point do you convert them into cash and in-cash them,
Sure.
What point do you decide that?
Okay, and let me put one more just context to this. It's a good thing you asked that question, because I'm rewinding back to the point I made where somebody said, we've been getting this question, what is long-term? 5 years, 10 years, 3 years, 20 years, what is long-term? And the standard answer is normally 5 years. She just vomited out 5 years. But the fact is, over the last 5 years, or till 2012 at least, it didn't look like that. And in fact, things were down over 5 years. So I think I would modulate that, which is what I would say is, if you, we look at price to book, as you could figure. P, the concept of P is actually not technically correct, but I'll use P because that's what everybody understands easily. When the market is at 20p, 20 times its earnings, it's normally it's not cheap. And if you're buying the market at 20p, you better have a 10-year horizon. If you're buying the market at 15p, which is what the long-term average has been, you should have in a 5-year horizon, you should typically, if earnings growth continues, I think working with a 15% type of return expectation makes sense. So 5 years is decent long term. If you're buying the market at 12p, even 3 years will probably be a good long term, if you ask me, enough to cover up for a lot of returns. So your time frame is also a function of when, this rule doesn't apply irrespective whether you're buying at the peak of a bull market, then you just have to have that much of a longer time frame to earn the same return. But in terms of the points, now that's a very individual thing, and that's something that Team Azure will probably explain to you better, because they will understand each individual in this room better. But they're different people at different points in their lives, have different requirements, different financial risk tolerances, etc., etc. Everyone's built differently. And the way you have to define it is really what is your point at which, let's say you stop earning and you need the reverse liquidity. That is your time frame. If that time frame is just a 3 or 5 year time frame, then you've got to then equities is a risky asset. Then you only have to put in as much as you're willing to compromise on, so it doesn't affect your lifestyle beyond a point. Then gradually you have to have more in debt, which earns less, but at least you protect your capital. If you're younger in life, any college kid, buying debt is a sin, frankly. You have to buy and put all your money into equities, because you've got such a long time frame ahead of you that you have to end up doing a really good job of it, or it will almost certainly outperform fixed income. So one crusade almost that we would have is to go into colleges and convince people, start investing early, because the investing early gives you the biggest power of compounding. Compounding is such a simple principle. I'm sure enough people have told you this.